Welcome to Capital Link's company presentation series.
Good day, everyone. I'm Raquel Cara, Vice President of Capital Link, and I'm delighted to welcome you to the 2025 Capital Link company presentation series. Since the president of the company, Nicholas Bernotis, is currently traveling, I will be stepping in on his behalf. In this series, company management highlights its current operations, business development, growth prospects, and sector outlook. Today, we're pleased to have with us the senior management of Pyxis Tankers, Mr. Eddie Valentis, Chairman and CEO of the company, and Mr. Henry Williams, Chief Financial Officer and Treasurer of the company. Now, before we begin, I would like to say a few words about the company. Pyxis Tankers currently owns a modern fleet of mid-sized eco-vessels consisting of 3 MR product tankers engaged in the seaborne transportation of refined petroleum products and other bulk liquids, and 3 dry bulk carriers, including controlling interests in true dry bulk joint ventures that own a Kamsarmax and Ultramax carrier respectively, and 100% owned Kamsarmax vessel, which transport a broad range of dry bulk commodities. Now, the Pyxis common stock is traded on the NASDAQ capital markets under the ticker symbol PXS. Now, in terms of logistics, we'll begin with a brief company presentation followed by an interactive Q&A session. Now, before we proceed, kindly note that participants can submit their questions through the Q&A button during the webinar, and their questions will be answered during the Q&A session. Kindly note that the webinar is intended strictly for information and educational purposes and should not be relied upon. The webinar doesn't constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. Now, let us now begin with our discussion, and I would like now to pass the floor to the CEO of the company, Mr. Eddie Valentis. Please go ahead.
Thank you, Markella. Thank you for inviting us again, and very happy to introduce the company to those who don't know it. But I'm sure that most of our audience are existing shareholders, and they would like an update of what's going on with the company and what we see for the near future, which in our view will be a very volatile situation for shipping. But let me start, as you said, in the brief presentation of the company. Okay, I have to go through that forward-looking statements and slide, which is on slide 2, and I will very fast take you through our company overview. On slide 3, we at Pyxis Tankers, we started as a dedicated tanker company, but since 2 years ago, we also entered in the dry bulk sector. So currently the company is owning 6 vessels, 3 product tankers, medium-sized vessels, plus 3 bulk carriers, again in the middle size segment. We believe this is the most versatile size. It goes to most ports in the world and has very good results in good and bad markets. The company has significant dry powder. We have gone through very good years in the last 3 years, almost 3 years. So we are in the good position, financial position, to acquire further vessels whenever we consider that the market and the conditions are right. We have, of course, long-standing relationships. The company goes way back, and it's a well-respected company in its sector. As of January 24th, we have approximately 72% of available days covered for the MRs and 68% of the days for the covered for the bulkers. We are positioned to further capitalize charter rates if charter rates increase, and we have already contracted 2 vessels under time charters, which you will see later at the next slide. We have a very strong management team, substantial experience in the shipping sector, and we consider that the demand fundamentals, both for the tanker and the bulk, are positive in the long term, and we would like to be in the position to take advantage of that later in the year by acquiring further tonnage. Going to slide 4, you will have a brief look of our employment. As you will see, 2 vessels in the product tankers are fixed for a year at relatively very good rates, considering where the market is today, and we will go through market fundamentals later. And the bulk carriers are unfortunately earning less. Market has been very volatile in dry bulk in the last 6 months. Also, we will discuss market on dry bulk later in further detail. Going to slide 7. The product tanker market is the product tanker market has always been correlated to the GDP growth, and this growth has been estimated to be in the region of 3.3% for 2025 and 2026. In January, the IEA revised its global oil consumption estimates, and now it's approximately 1% growth for 2025. And in December, also OPEC Plus announced a further delay in the gradual unwinding of its oil production cuts of 2.2 million barrels per day, which will start in April 2025, which signifies that they expect a firmer demand and supported crude prices.
Paul, can you move to slide 7, please? Great, thanks.
Q4
Sorry.
2024, we've seen easing of global demand for refined products, and despite the resilient economic activity, and although in some areas the inventories were still at below 5-year averages. So we've seen a market which has been softer in the last 6 months, and we've seen an improvement in the market this January, driven mainly by seasonality. The longer-term product tanker demand will be supported by increasing worldwide refinery throughput and capacity additions, mainly in the Middle East and Far East. Going to slide 8. Of course, geopolitics have played a big role in the market the last 2.5, 3 years, and Russia-Ukraine situation has resulted in the expanded ton-mile demand, and this has still been the case. And of course, the Middle East situation has resulted in the attacks in the Red Sea and area in the Aden Passage, which has resulted in less passages through the Suez Canal, and therefore more ton miles created by this situation. This is gradually unwinding, and with the recent truce between Israel and Hamas, it seems that things will be normalized if things go as planned. So we expect this situation to normalize within this year. The Q3, I said, since Q3, we've seen a decline in charter rates. Although the demand is stable, we've seen also there is a lot of uncertainty going forward, and this will be also a major issue which we need to see in the near future. And I'm talking about tariffs and how the market will be affected by possible tariffs from the US on various imports from the US. Exports now from the US have been stable to increasing, and this is a positive story for us. The refined products seaborne trades have increased by 2.4%, and the ton miles have also rose 4.6%. Sailing distances up to 2.2%, and ton miles in the last quarter, second half of 2024, have increased to approximately 5.6%, despite the slowing growth in seaborne trade. So geopolitics will play a huge role in the next this year. I mentioned tariffs. I mentioned the situation in the Middle East, and of course there is the question mark of the sanctions and whether the Russia-Ukraine war will sort of de-escalate, and there will be an easing of tariffs, which I guess is a big discussion, but it's on the table. Therefore, there is volatility now in the spot market, in the tanker market. Going to dry on slide 9. No, sorry. Slide 9, we've seen the order book. For the MRs, it's a big order book. 16% currently of the fleet is on order. This means the heavy delivery of vessels for this year and next year. Of course, slippage is an issue. I mean, delays in deliveries is an issue, but nevertheless, there's a lot of new vessels coming in the market. Of course, we have to consider that a lot of vessels are 20 plus years of age, which at some stage will be scrapped. And therefore, this fleet, 20 plus years, is estimated to be around 17% of the fleet. Therefore, in the long term, the longer term, the fleet will be stable if these vessels are scrapped within the next period. The new regulations are coming, I mean, already here, but as of 2023, this is creating a lot of vessels to slow steam, and we believe that some vessels, older vessels, will have very high running costs, and therefore will be a two-tier market developing between eco vessels and older vessels. Going now to slide, just to give you an idea of the prices. New buildings today around 51 million for MRs. 5-year-olds around 41 million, and 10-year-olds around 37. But its asset values are coming off, and I'm sure that if the market continues as it is, we will see softer prices later this year. Going to slide 12, dry bulk. Historically, the dry bulk market is strongly correlated to China. This is the primary driver for the dry bulk rates. Major bulk items, iron ore, coal, etc., are, and in some cases, grains as well, are very much linked to China. According to a major broker, Clarksons, we've seen Chinese GDP reported to be around 4.6% for 2025. And they're expecting it to be 4.5% next year. But there are concerns about the Chinese real estate market and how this will adversely impact the market for imports for iron ore and coking coal, which is a major product, major cargo for our vessels. There is a report that seaborne dry bulk cargoes have grown to 5.3% in 2023, and ton miles also increased 8.2%. This is estimated for 2025. So cargo volumes, dry bulk volumes, relatively flat, 5.8 billion tons versus the prior year, but up 2.5% for minor bulks and 1.5% for grains. Also, we expect that the various Chinese stimulus programs, Chinese government stimulus programs, will come in play and will be constructive for the dry bulk market. The order book, according to a major broker, Arrow, the order book is around 120 million deadweights, or 11% of the worldwide fleet of dry bulk vessels. Again, here we have a significant number of vessels, approximately 16%, which is above 20 years of age. So we estimate, again, as in tankers, also in dry bulk, there will be a two-tier market developing, and the older vessels will have to be scrapped at some stage. So asset values, we go to the next slide. For Ultramaxes, around 34 million for new buildings today, and for Kamsarmaxes, around 37 million. 5-year-olds, Ultras 32, Kamsars 34, and 10-year-olds 23 for an Ultra and 24. Again, these prices are relative because we haven't seen any real activity in the last couple of months, especially for modern tonnage. So we expect these values to come off as well in the next near term. With this, I will hand it over to Henry for the financial highlights.
Thanks, Eddie. Let's flip to page 15. Yeah, this is the 9 months unaudited income statement highlights through September 30th of 2024 versus 23. This you'll see is reflects good revenue growth and solid profitability. Clearly, the takeaway here is changes in the fleet. As you can see down below, we sold one MR during 2023. That reduced us to 3 units for the 2024 period. At the same time, as Eddie mentioned, we've expanded into the dry bulk business. So when you look at this, you see overall for the 9-month period, a nice increase in time charter equivalent revenues of 25% to over $34 million. Importantly, you see adjusted EBITDA increasing 39% to $20.7 million. The difference in really net income versus the 2 periods is that the period for 9 months in 2023 reflected an $8 million gain on the sale of the MR. Down below, you see utilization factors that are good, solid numbers for the comparable periods overall. But most importantly, you see the total number of operating days increasing roughly 23% because of the fleet expansion. With that, let's move to the next slide. This is the capitalization as of September 30th. And you see total cash position of almost $44 million, net debt to total capitalization 22%. Our next loan maturity is almost 2 years away in December of 2026. I want to point out some important elements to this that have happened really subsequent to that date, is that we've continued with the common share buyback program. We've almost spent the full $3 million under that program. We've acquired roughly about 730,000 common shares to date. But I would say equally importantly is the fact that we've fully redeemed during 2024 the Series A convertible preferred stock, which saved a significant amount of potential dilution. In aggregate, we've spent over $13 million and now have avoided potential dilution of over 2.5 million common shares on an equivalent basis or total basis. Moving to the next slide. This is where we were as of last Friday from the standpoint of shares outstanding, roughly 10.5 million shares. The public float's just under 4.4 million shares. Insiders own 58% of the pie. The only other security that is publicly traded beyond the common stock is some warrants, roughly 1.6 million common stock purchase warrants. They have a strike price of $5.60. Those warrants do expire in mid-October of this year. I want to just touch a little bit upon our fundamental valuation metrics. One of the leading research analysts that follows us, basically in his most recent report, which is about 2 months ago, he had an NAV of roughly $12.50. So we're trading at a significant discount, price to NAV roughly being about 30%. If you look at other valuation metrics, price to book value, and even if you obviously subtract the impact of the redemptions of the preferred stock as well as the common stock purchases, we're still trading at 40%, less than 40% price to really tangible book value. PE multiple, the multiple based upon the model that's currently out in the marketplace is roughly a 2.4x, and EV to EBITDA roughly 3.3 times. So whatever valuation metric that you want to look at from the standpoint of other U.S. shipping peers within our sectors, or you want to look at it in a relative basis regarding other NASDAQ small cap companies, clearly a very attractive valuation for Pyxis Tankers. With that, let's go to the next slide, which is the wrap slide. Clearly, we think we are well positioned for some exciting opportunities. Clearly, as we move into, I would say importantly, the second half of this year, there may be some very exciting acquisition opportunities, and we have the financial power and expertise and relationships to effectively grow the fleet at the right time, at the right price. With that, I'd like to flip it open to questions. Let me take a look. Let's see. One of the questions comes up, do you anticipate paying dividends? This is something we've discussed many, many, many times. The reality is we felt it was much more compelling to use cash to redeem the preferred stock and common stock. As you've heard, we have redeemed over approximately 20% of our equity through spending roughly $13.1 million. That is a very compelling proposition. We now are sitting, even if you look at the adjusted number for September 30th, being roughly about $35 million in cash. Obviously, during the fourth quarter, we had free cash flow generation. So the perspective is we want to utilize our cash and a reasonable amount of leverage as appropriately to potentially acquire tonnage at the right price. So as to paying cash dividends, that's something that's not on the top of the list for Pyxis Tankers.
I will take the next one. How are time charter equivalent rates trending in current market? What are your expectations for 25 first half and second half? I mean, the time charter equivalent, I mean, it was down. I mean, we've seen a recent spike in product rates recently. Therefore, we decided to book another vessel on a 1-year time charter because we consider that the year will be volatile. It's very much dependent on geopolitics, the market, and considering that also as from March, April, we will see seasonality kicking in, therefore lower demand. We decided to take that position. I mean, still today, I think for 1 year, time charters are around 22,000, which are equivalent or even a little better than the current spot rates. I mean, it is volatile, and we will continue to be volatile for the next couple of quarters. The question mark is about dry bulk and whether it will come back, because for dry bulk seasonality kicks in April, May with the grain cargoes. Therefore, we expect this to be stronger and the dry bulk to come back stronger for the next quarter. So even sooner than that. So yes, it will be volatile, but it's not the same market as it was a year ago. The other question we have here, how do you improve share price? Henry, you want to take that?
Yeah, I mean, obviously, we have done a lot from the standpoint of our equity position, from the standpoint of repurchases and the buyback. What we, you have to deal with things within your control, and clearly trying to put up good operating results, financial results are cornerstones to that. Continuing to dialogue with research analysts and investment community, obviously that's very, very helpful. I think, major catalysts obviously would be a material acquisition or two, expanding the fleet from hypothetically 6 units to 8 units obviously is a significant benefit. So things like that are going to be very helpful. Clearly, a more positive view from the investment community, investment sentiment would obviously be helpful. All boats in a rising tide. So these are the things that we try to look at is things within our control, but obviously a fair amount of things are outside of control, especially in a very volatile environment. Management owns 58% of the pie. We're sailing in the same boat with the investment community, with the public shareholders. So we get it. And so we're always looking at ways trying to maximize value. But clearly, we are very cognizant of a heightened, unstable global environment today. So we will continue to manage the business very prudently.
It has been a wild start to the new year with various geopolitical announcements. Tell us about them and how it affects our business. We discussed this earlier. It is really, I mean, the market was in a wait and see situation the last quarter, considering the US elections, etc. This is significant because besides the tariff danger and what that may cause to the market. We also have various situations which might unwind and others which might escalate. Okay, we talked about the Middle East, which seems to be on the right track of unwinding, and therefore the passage to Suez will be normalized. We talked about the possibility of Russia-Ukraine finding a peace situation where maybe at some stage the sanctions will be softened, but this is a big story and a big discussion. And the other situation which might evolve is also the Iranian situation. The new US government has been adamant about that they will press Iran very much in order to create a new situation in that country. Therefore, we might see other situations developing and other geopolitical pressures in the market, which of course will benefit especially the tanker market. So it's been a wild ride. We've seen also the sanctions on various Russian ships. Approximately 160 vessels have been sanctioned, which is significant. And of course, 2 companies have been designated as terrorist companies, which are huge companies like COSCO and CIMC. So these are significant moves, and we expect to have some effect in the market in the short term. But we're still waiting to see the first, let's say, the famous 100 first days of the new president and how he will tackle those various issues that we discussed. I mean, there's another question about near-term capital allocation plan, but Henry answered that. We will consider opportunistically acquiring further vessels. And of course, we might expand our buyback program. This is something to discuss internally since the share price is at very low levels considering our NAV. So yes, this will be an option for the near term. I think we answered most of your questions. they're all similar. The question about daily break-even rate across 6 vessels.
Yeah, that's just the across the entire fleet. The total cash break even is just under $15,000 per day per unit, and that is covering full OpEx, G&A, as well as complete debt service within the organization, and that's the so-called estimate for 2025. Related to another question on 25. On slide 4, there does, in the middle of the page, the question is, how much of our revenues for or days covered for 2025 as of January 24th, approximately 34% of our remaining days were covered for 2025.
Yeah, another interesting question is how will the sanctioned ships affect the tanker market? Yeah, definitely. I mean, this will be a big story, considering that these tankers will most probably, and seeing what's happened in China, certain ports in the East Coast announced that they will not permit sanctioned vessels to discharge Russian and Iranian cargoes. So that automatically will have an effect, and this will be for the fleet which is not in the gray zone, in the so-called dark fleet. So this is a big hit for the dark fleet, for the gray fleet, and well, this is a positive sign that the Chinese will use vessels which are not blacklisted or do not do sanctioned cargoes. It's a good development. Overall, yes, they will be scrapped at the. I mean, supposing we reach the situation where sanctions will be ended, we consider that these vessels will be scrapped because the logic says that they will be blacklisted forever and they will not come back in trading. So yes, a good question. They will be scrapped. They will not be back in the market. This is our belief, but of course, remains to be seen.
Yeah,
I
well,
think
I'll just touch on that real quickly. The average age of the tankers that are in the dark market are reportedly about 21 years of age or more. Obviously, the running costs for those vessels are a lot higher. The whole issue about insurance flag, the whole 9 yards, let alone the fact of gaining any type of employment, alternative employment, is really seriously in doubt. So the number of vessels that'll be scrapped will be huge.
I think this covers it. Regarding Europe, I think we discussed it. Sanctions have not been lifted yet, therefore the situation will remain as it is. The routes that exist after the Russian embargo on Russian products will continue, unless there is a substantial change in the near term, which will permit Europe to import again without any restrictions from Russia. So we don't see anything changing in 2025, at least in the short term. Why we diversified into dry bulk? I mean, this is going to question about diversifying the company altogether. The in 2 years ago, when we decided to enter the dry bulk space, it made sense because asset values had come off in the dry bulk, and asset values in the product sector were sky high, historical highs. So at that stage, it made sense, instead of investing, since, as Henry mentioned, we had sold a couple of vessels, it didn't make sense to reinvest this amount in sky high levels. And therefore, we decided to enter the dry bulk market. I think back then was a good decision, considering that the asset values were attractive. So it was a counter-cyclical move. And considering, I mean, let's be frank, I mean, we were expecting that the company and the stock price will be higher. And considering that it's been a 3-year run in the tanker sector, and with very healthy results for the company and for the valuation of the company. We thought that the stock price would be completely different. So we said by diversifying the company, making it a more wider to attract more vessel types. Maybe this is something attractive also for our shareholder base. And in markets do not really tanker markets and bulk carrier markets do not really correlate. So maybe dry bulk market would be better in the coming months and tanker markets down. So in order to have a diversification, maybe going further, I mean, maybe it will improve and have a better, let's say, a return for the company going forward. So that is the reason entering the dry bulk space. And again, we are opportunistic. We will look at the opportunities as they come, and if they make sense, we will proceed with that. So going forward, yes, we will consider both dry bulk and tankers for acquisitions. The last one, I think, is for you, Henry.
That's the question about the $15,000. $15,000 is total cash break even, covering operating costs, G&A, as well as complete debt service. That's principal and interest payments per vessel per year. So the reality is that covers everything that is per ship. So and the only thing that should be also considered is that we do have special surveys. We have two, for example, that'll be coming up within the next 90 days. That's two of our 2015 built Kamsarmaxes. We're going to spend an aggregate $1.5 million for the two units in their special surveys. But those are sort of one-off type events that happen every 5 years or so. So really, when on a normal, you have to look at it on a normal basis, which is total cash break even, again, running OpEx as well as G&A costs, management fees, as well as complete debt service per unit per day. Thank you.
Regarding the last question, yes, the repurchase of shares makes sense. We have been doing that the past years, and we will keep doing it. It makes sense, of course. But I'm saying again, I'm repeating that asset values, and when they come to historical averages and even below historical averages, we will consider. I mean, the company is a growth company, so we need to be growing whenever the market gives us the opportunity, and the market gives us the opportunity when the charter market is bad and the asset values are low. So we will continue doing that. So whenever we find opportunity, I mean, we have significant cash balance now, so we can sustain a bad market. Therefore, whenever we find an opportunity, we will, of course, consider. And if you give us the opportunity to increase the share price and make a meaningful capital raise, we will, of course, consider buying vessels at the right time, and which makes sense for shareholders. And again, as Henry said, insiders, we are very much aligned with shareholders. Therefore, we need to be making, and we want to make the best for the shareholders. And this have been our motto and our way of doing things as long as we've been in the public market. Thank you. I mean, with that, I guess we're finished. Thank you, Markella.
Thank you for
Thanks.
taking the time to join us and for sharing your insights on the market dynamics. And of course, I would like to thank our viewers for their engagement. I believe we've received a thoughtful lineup of questions today. So as a reminder, today's webinar will be available on Capital Link's website and on our YouTube channel later today. I would like to thank everybody again for joining us today, and we look forward to welcome you to our future company presentations. Thank you.
Thank you, Markella. Thank you all for
Thanks.
joining us, and hope to do it again in a few months and update you on what's happening with the company. Thank you very much.
Right. Bye.